G'day, buddy miners. It's Lithium Day. We've got bloody Mins, Liontown, Pilbara, bloody, and Meeka. Meeka aren't mining lithium. Good on you. That's why the share price is going up. Good stuff, Meeka. I think this is the last day live, besides tomorrow's episode, that we get to mention MMS at the start of the show, because pretty much they've done a lot of work, but because of me, their business has got to a point of getting contracts and it's just flying. So I don't want to take all the credit, but
keeps flying.
Okay, well done, MMS. They're taken off, and thank them for the support. Like, hey, GC, money of mine. If you want me to turn you into an MMS, what a bloody offer to the punters out there. Right, let's start. Mineral Resources, the most talked about company on this show this week.
The gift that keeps on giving, hey?
And in the bloody newspaper. Quarterly's out, bringing in some dosh for some gas. Mate, let me guess, Trav, you'll be talking about this today.
Nah, yeah, I am.
Take it away, Sunshine. What's going on?
Yeah, mate, there's so much news out today. Unfortunately, we can only talk about, like 4 stories or whatever. But if you want to make sure you're getting all of the stories, make sure you sign up to the Director Special. Just go to moneymind.com, sign up, and you won't miss any of them because, we've got limited talking capability. So
can't be a more simpler web address.
It's pretty easy. Leave your email.
You pick that every time.
Get it first thing in the morning.
Moneymind.com.
But MinRes, Matty, there's a lot of talking points today. It's the first one obviously is the fact that the share price is up like 14%, which is amazing. But why is it up? Well, I think it's got a lot to do with the fact that there was a gas sale with MinRes' most of their energy business. This sale has, I think, been the driving force behind that share price hike. But MinRes has effectively sold its entire interest in the gas assets that had sort of substance to Gina Reinhardt's Hancock Prospecting, and it's retained a 50% interest in the less kind of meaningful Perth Basin and Carnarvon Basin exploration assets. For simplicity, just assume MinRes has divested its gas assets to Gina. In exchange, MinRes is getting paid $804 million in cash up front. And depending on how some drilling results go with some of the assets it's divesting, there's an additional $300 million that MinRes can get paid from Hancock. And if you just look at that waterfall chart, some of that cash is ring fenced for drilling in the exploration JV that Min retain with Hancock in a 50-50 ratio. So the number that really matters in that waterfall chart is the $780 million up front. The CFO on the call guided to a 17% tax on that. So in reality, there's like $650 million after tax cash coming in the door shortly, which certainly helps the fears in the market around the balance sheet.
God, they'll be bloody praying Gina finds something on those exploration assets since they're free carried for their 50% interest.
Yeah.
So, go Gina.
Yeah.
What do you reckon of the deal, mate? We spoke about it, a couple months ago when it was sort of doing the rounds when the balance sheet troubles first started to hit home, and we sort of quoted a few energy analysts, the numbers they'd kind of tossed up. What did you kind of come to in your digging on the price tag?
I think it's relatively healthy, probably kind of par. Like the numbers that were sort of thrown around like 6 weeks ago. Sol Kavanagh cited 500 to 900 million, and Adam Martin cited 500 million to equity research analysts out there. What's changed in the interim, though, is that WA's domestic gas policy emerged, which gave some certainty of some exports from development, which I guess bolsters the economics of these undeveloped assets here, because you've got some, I think you changed your risking on these undeveloped projects. It's less risky now, and you've got more visibility on what the policy regime is going to be that can help you get a higher price for a proportion of that gas for a period of time. That point there on the gas policy was actually explicitly called out in Hancock's own press release. So I think there's a few things in Hancock's own press release that were worth pointing out. I'll flash it up here on the screen, but the first one that just stands out straight away is this quote from Gina, which says, "I welcome the opportunity to work alongside my friend Chris Allison and his MinRes team." I think that's a telling sentence in itself, right? I think Gina...
Just a couple of powers. How good?
Well, it's... I'll let you say it.
I think she chooses her words pretty carefully in media releases. That that to me suggests two things. One, Gina believes Alison is hanging around to steer MinRes into the future. And two, she's willing to lend her own credibility by calling him her friend at a time when his character is massively under the microscope.
Yeah, yeah. And like that, the only way you could other interpret it is saying that working along my friend Chris and his MinRes team, which he created, saying that they were separate. But I don't think that is the case. Because that, as you said, if it comes out a week later, that's not the case. It'll bite us. So you got to choose it carefully. When you're that bloody rich and powerful, I don't have to choose my words carefully.
The same rhetoric is even sort of parroted by Hancock CEO further down in the release. If you care to read the rest, you'll also see like some lobbying effort for enhanced export capability has already begun because that'll bolster the economics of the development of these assets even further. One last thing on the gas though, I think you can sort of see in this map here, Gina's she's consolidated some acreage near her existing interest in West Erregulla and Erregulla Deeps there. That's where she's got the JV with Strike Energy after the acquisition of Warrego. Strike Energy, an intraday winner here on the news. Their share price is up 9%.
Yeah, right. So okay, that's the sale. What about the quarterly, which is lithium and iron ore?
Exactly. Yeah, mostly mining services is the big driver of that too.
Okay, and that's what the quarters will be now, just lithium and iron ore because the gas is.
Yeah. They'll still separate the
and mining service. Yeah,
CSI. Yeah. Firstly, there's nothing on Alison on the call, or the quarterly sort of as a snippet, but everything's just deferring kind of any conversation around that or questions around that or answers around that until Monday, which was already flagged earlier in the week. So, like the call wasn't very juicy from like a drama perspective, unfortunately. But I do think there's a bunch of talking points here. Onslow in particular. So now we're getting some ramp up data come through. As at October, MinRes say it's doing 10.6 million tonnes per annum annualised. They say 35 million tonnes per annum nameplate by June is still expected. And the last stretch of the whole road was just completed. So they're now using all 150 kilometres of that whole road.
So the whole road is completed effectively.
It's completed from like a practical perspective. There's still some a bunch of underpasses and things like that are required for I think drainage and stuff like that. Which with cyclone season approaching, it's going to be important to get that stuff sorted out too.
Yeah.
There's on Onslow, MinRes, they do claim that Onslow's now operating cash flow positive in the month of October if you include the mining services business as well. Operating being the key word there as well, and I'm curious what's being capitalised, but there's still a bit of work to do, like on the underpasses. So there's still a bit of capital spend, like I mentioned. There's a few caveats to make here before kind of jumping for joy that's all cash flow positive because operating cash flow excludes investing cash flow, and financing cash flow, and it's the interest repayments that we're all of that stuff matters, right? So, and then the other point to keep in mind is I kind of picked up in the call that the mining services contract is structured to, I think, charge higher rates during ramp up to kind of account for that. So
physicals.
So you can't just, if the mining services business is an outsized contributor during ramp up, you expect that to taper off as your volumes increase. So, but on the plus side, like Onslow ramps, the volumes efficiency should lower unit cost too. Another point is just on the realizations that they're selling the iron ore for out of Onslow. This surprised to the upside. I was worried on this front, but they got 88% realisation of the Platts 62% index at Onslow, and that's a fair bit higher than the 81% realisation that they're getting from their Yilgarn and Pilbara hub as well. So it's positive front on the product quality so far, albeit not much volume has gone there, but it's still a plus. And the third point I wanted to talk about there, it's actually some clues on maybe like a rejig in long-term costs as well. There was some verbiage in the call that like the $45 per tonne FOB at nameplate might have some escalation pressure applied to it, which was alluded to by the CFO. So some positive stuff there, but I think there's enough there for the bears to grab hold of too.
And what about CSI?
The mining services business, this is pretty interesting, right? On the call was also the head of the mining services business. And as usual, there was a question from Ben Lyons at Jarden, which is worth playing.
Yes.
It's greatly appreciated. Just in the comments, in the context of your comments about the strong level of external customer inquiry, I also note some other recent high-profile wins by others. For example, the Rio Godaideri contract, which was won by DesTech. So it appears that the competitive environment may have increased, and I'm also concerned about how some of those high-quality counterparties like Rio and BHP, for example, might respond to the recent press disclosure and those lengthy internal and external investigations which are currently underway. So I'm not expecting you to comment upon those investigations, but I'm more concerned about what MinRes is doing to shore up CSI's protective moat and approved vendor status to key clients such as Rio. And secondly, if you can possibly confirm whether there's any major CSI contract renewals coming up, please.
Yeah, I mean, I can talk to that, Ben. It's Mike. Great question, and it's an interesting environment, but essentially, I'll just answer you the Godaideri question. That's 2.5 years old, that news. And as you'd expect in the market, when you've got a significant footprint like we do across multiple commodities, we get tested, and the environment creates competition, and that will always occur, and that's actually quite healthy for it to occur. So we live with that every day, and there's jobs that we win, and there will be jobs that we lose. But on the main, we don't lose too many at all. And
that was a kind of interesting question, right? And the DesTech contract point, I think it's kind of an interesting. It's an interesting point, even though it is 2.5 years old. It's topical at the moment, partially because of all of the other headlines that are going on. But in February 2022, DesTech won a crushing contract with Rio Tinto for their $4.6 billion Godaideri iron ore expansion project. Then things appeared to get a bit spicy because DesTech is led by Chris Allison's old co-founder, Steve Wyatt. They co-founded CSI together all the way back in 1996. MinRes started suing Steve Wyatt for alleged intellectual property misappropriation that was used to win that contract with Rio Tinto. It all got a bit messy with the Supreme Court giving the go-ahead for MinRes to rifle through the files of DesTech, and even Rio got caught in the crossfire getting subpoenaed for documents too. And by the way, if you go all the way back to like MinRes' prospectus back when they listed in 2006, you'll see Steve Wyatt in there named with Chris Allison and Peter Wade in some of the related party transactions. So, like you can make your own hypothesis about some intertwinement that, could be with the Far East tax stuff too, but all of that's kind of uncertain still at this stage. But I'm kind of digressing here because the mining services business, I think, is the backbone of MinRes, and the broader point is interesting one. Is it getting more competitive? Like what's the outlook look like for MinRes to continue to grow that business, especially in the face of kind of the decline of its more marginal operations in the lithium and iron ore parts of their business? Can they continue to win and grow that mining services business? Is the competition getting fiercer? Do they still have the ability to jack up rates? Or how does Rio Tinto and BHP and the likes think about that? It's an interesting question, I think.
You didn't answer the ones coming up for renewal. That's unknown, no?
Yeah, I think there's always ones that kind of come up for renewal over time, although I don't have a particular amount of colour on that. There's, but yeah,
it was a big talking point in the last quarterly, just the margins and I guess how superior they are, and the fact that they continued to grow. It's been a big part of the men's narrative. So I think you're asking the right question there. It's a tough one to answer though.
The last kind of two last big talking points in the news today. One is just the severe kind of lithium business rationalisation. I won't go into it too much, but there's it appears that the lithium business has been under a tremendous amount of pressure. There's again no detail on what the unit costs are, and they're reporting across their operations, but they said 570 employees have been already laid off, which reflects mostly the lithium business and some of the Onslow construction sort of winding down. It doesn't include the Yilgarn impact yet. On Wodgina, That's had a hard time with transitional oil at Mount Marion. Kind of capital spends tapered massively. Like even the exploration decline work on that sort of ending by the end of the year.
Yeah, they're exercising like a no fault early termination with develop on that one for the end of the year.
Old Hill, like the rhetoric there has not changed in the 12 months they've had the project. They keep saying the line, we're still figuring out what we've got. And then geology, they're still getting their heads around it, apparently. It's been 12 months now.
Well, laying off 570 people and putting all the lithium business on 2-in-1 as well. So that's
there's a lot of cost out initiatives going on. There's a bunch of fleet that's been sort of freed up, which they said they were going to sell like 60 to 70% of that sort of fleet that's been freed up as well. And which of course brings us to the last talking point, which is the balance sheet. I think like a notable omission from the quarterlies, any colour on leverage as at 30th of September. Even when asked on this point, the CFO Mark said, no comment where it is right now. It was the first time I heard MinRes speak to the potential to refinance its first bonds, which they can do around April next year. Mark said at par, and I think those first bonds are the $700 million bonds, which are due to be repaid in May 2027. I think it's worth pointing out that the credit rating agency Fitch, they downgraded MinRes' credit rating last month from BB to BB negative, the minus there being the outlook. So any refi is likely going to be a much more punitive interest rate than we see in Min's bonds to date, but
likely a much later maturity date.
Yeah,
that's the aim.
You can roll it, but you pay a higher interest rate. Pay more in interest, roll it, refi it. That'd be the play. And then when kind of asked, the CFO rattled off the remaining levers if things get more skinny on the cash front, which I thought was worth playing as well.
It's something we're looking at in terms of other levers. We've said for quite a while that we've had levers in the business that we could pull in terms of, and we've got, I don't know what the number is, maybe 10, 12 different things on our list of things we can do. I mean, if I needed to, I could sell the other half of the haul road as an example. Not that I want to do that or need to do that. We've got other opportunities in terms of releasing capital from surplus fleet. We've got some lithium investments that are listed we could sell if we absolutely had to. Still got the Onslow JV carry loan receivable, which has got real value, and we've had interest from third parties in relation to that. We've got other divestments we could make. So there's a range of choices that we have.
What do you guys make of that list he rattled off?
At least he's got gold. They've got gold exposure with Delta Lithium now. So at least they're in that.
I mean, I think the overall market reaction today is a sign of slightly less concern about the balance sheet. I think that's the main driver in the tick up that we're seeing, obviously on the back of the transaction. As to the other ones, you might be saving yourself for foregoing earnings in the long term, but that's the situation they kind of find themselves. And just to comment quickly on the bonds as well, they might catch a bit of luck as well as rates decline, US rates decline. That might offset the potentially more expensive rates that they have to pay. So I'm sure that's another thing they'll be hoping for.
I know the rates are declining, but like you look at that, what Fitch did they said they'd previously forecasted net leverage to be at 2.2 times, and it was 4.9 times. So you can see the ratings agencies have had a pretty big kind of pivot in leverage expectations. I don't think that will be paying.
I didn't say I was going to save them. I said it's just it's one thing going in their favour.
Yeah. I think it'll be a higher interest rate if they can refi. But on the
I look at the lithium stuff as like we talk about counter-cyclical investment, which is what would buying lithium be right now. Is it the same if you hold it, keeping it versus disposing of it?
It's probably just more a face-saving thing in some ways.
Yeah. So it's like, would you get rid of them at the lower prices, or would you like?
Well, that's
we're in.
I think it makes for a super interesting chat, and maybe worth bringing up again after you speak about Liontown, and we mentioned Pilbara as well, because each of those companies have made decisions as well that are market condition dependent. Makes it very, very interesting time.
Yeah, and I don't think that their equity positions in the lithium companies are really move the dial too much if you sold them.
Like
but
a
the one
quarter of $1 billion maybe.
Yeah, and the one interesting one there is like the opportunity maybe for Pilbara to actually be countercyclical and buy the Wildcat stake, for example. Where they can probably achieve some synergies in some respect. So that's the one that sort of stands out to me as kind of interesting if Pilbara were being a bit opportunistic. But it was the first time I heard Mark talk about the carry loan receivable. So there's this the way the carry loan is structured with the JV partners at Onslow, there's the ability to actually have a third party acquire that receivable. So MinRes gets money in the door, but then the early cash flows out of Onslow actually go to that third party instead. So that's another interesting one. I don't think it's going to be cheap if they did that though. But those are what he means when he talks about levers. He didn't actually mention selling any of the lithium assets. So that was kind of interesting in terms of like the actual processing facilities or anything like that. But yeah, regardless, like there are levers. I think there's also enough sort of doubt on the ability to kind of really move the dial too much on the things that he mentioned there as well. If iron ore price came under a fair bit more pressure too.
He didn't mention an equity raise.
Yeah.
I mean, it is a genuine lever as much as they don't want to do it. It is something that would pull them out of a bit of trouble. So
yeah,
we'll sort of see. But obviously, they're not going to be flouting the intentions to do that.
The last thing I wanted to sort of ask you guys is any predictions for what comes out on Monday as a result of the clues that we've had so far.
Oh, the other one, which before you say that, was just looking at the map. Imagine if Gina bought Wodgina to send
their share of it,
to send Andover down there.
Maybe.
It's just south of Headland. I don't know how far it is. It's a bit, but wonder if that's another lever.
Maybe.
Because that's a processing. I would say that is a processing solution. We'll just keep that. It's recorded.
Yeah, and she'll be running the numbers for sure.
And that's like a talking point too, right? It's like Gina's sort of signalling that, she's pretty supportive of Alison and
they can do deals together.
In some ways, there's maybe Min shareholders feel a bit protected on the balance sheet front, knowing that Gina might save the day in some respects too if things got too dire. But yeah. You can't count on it.
We'll see. Yeah. All right. Predictions for Monday. What are you putting more weight on? Him retaining the MD position or being removed from the MD position but still being in the company of some capacity?
Either one, I think, is probably the same thing, which is Chris is still steering the business. And I think everything we've seen today and, is setting up, it looks like to be setting up a strategy that is going to be a Monday announcement that he's either directly or indirectly still steering this business. I don't think he'll be fired. Like that's the read through I get in Gina's comments.
I wish they had this on
being removed from the board.
I think that's maybe possible. Like I don't know. I think in terms of like, does anything really change from the way that business is run, whether he's on the board or not? Probably not.
But how much? Like, do you think that'd appease the media? Like, not appease, but in terms of removing as much of a spotlight?
I suspect it might light a fire up the media. Like the big unknown is like, what's the media still sitting on? Like, what's left to come out? Because it's appeared like there's been a strategy to strategically release information wait for the board to respond to that information and then discredit the board by revealing more evidence he was sitting on that basically shows that the board's initial comments were maybe not particularly truthful in all respects.
It's not like every article's just been researched after the last one was released. It looks like it's all been strategically drip-fed, as you said.
And I think there's still plenty of risk that what might be yet to come out is worse than what's been out so far, and that could put renewed pressure on his spot, contrary to the strategy that appears to be for him to hang around. But you can't comment on the likelihood of that until it comes to the market or to the media. Yeah.
Mm. Oh God, I won't be able to sleep this weekend. It'll be a big day.
I think you guys have nailed it. I'd love if they had it on like Polymarket or something. You could see the odds of him sort of staying in the business, leaving the business.
Is this on Sportsbet?
Oh, it should be. It should be.
Fuck, if the election, this is pretty much the federal election in the mining industry. Like, this is huge. Oh.
You know, it was just huge, Matty. Liontown. That was a very, very highly anticipated quarterly. What did you sort of get at in your findings, and how's it sort of looking?
Well, first quarter of production results. As I said, they did, it was like started, I think July 31st was like the sort of the start of what they'd say production. So this was going to be the telling quarter. But remember, ramping up a whole of ore flotation circuit is pretty much like telling me to learn Mandarin in a couple of months. Like it's like, I don't know, maybe I could do it. You know what I'm like when I put my mind to something. So they threw in, it's just one of them things, no matter how much bloody planning goes into it and how good they reckon they've built the bloody thing, it's always going to be very hard work. But it appears it's going in the right direction, because they threw in 282,000 tonne of dirt in 2 months, produced 28,000 tonne of dry metric spodcon. So recoveries have an average of 51% in September. So last couple of weeks of September, they were hitting sort of the 55 to 56% mark. They said in the call there's been some days where they're in the 60s. They didn't disclose what the actual feed grade of the dirt is, I don't think. Couldn't find it. So we're unsure if they're putting through 1% lith or 1%, 1.2% or whatever. We just know the grade of the con that has been coming out. So remember, they aren't stoping yet. So it's just open pit ore, a little bit of underground development ore, I'd say. It was only 19,000 tonne of development ore for the quarter. June quarter did say first development ore was going to be hit in August. So, and it also said in the June quarter that first stoping was to commence at the end of this year, calendar year, but no comment in this quarterly about when stoping will commence. They didn't reaffirm that or anything. So if you look at the waterfall chart, even though the title reads cash increased by 140 million, that's as a function of the convertible note issue, but expenditure for the quarter was 231 million. So closing cash at 263 million. They come in a bit under some of the analyst models that they had of what their closing cash would be. Debt position, 662 million. So it appears all the construction costs of the project will be completed by the end of the December quarter. So they're saying about another 65 million outflows for that December quarter. That includes like 13 to 15 million for the paste plant. That sounds like that's about a bit over 91% complete. Not required for first production, but only for when you start filling the bloody stopes. Still got to get the retick and the boreholes and all that in place, but you can start ripping the arse out of the stopes well ahead of that going in. So it appears that updated mine plan has been delayed, I think.
Yeah, just in terms of the cost guidance, everything like that.
Everything, and what they're going to do, like what the con's going to be, like everything. Because I remember hearing, or I thought, I was told it was sort of going to be potentially close to when this quarterly come out, but they've said in the announcement though it'll be an update by the end of this calendar year. So that might have been, though we are getting close, so it might be another fucking month and a half away by the sounds.
The trend has been they've just kept pushing this back, though. Remember, it was going to be before the debt, and that got pushed back, and it was going to be, you know, around the con and then the con note, and then it just kept getting pushed. I think obviously the actuals are pretty variable and improving. You're trying to figure out where steady state's going to be there, but you're also like, you don't really want to put out numbers to the market that show you're losing a fair bit of money on every ton, like while the market's still kind of busted up from a realised price perspective.
Yeah, and I think there's a lot to come out of that, and there's obviously a lot of iterating to do to figure out the balance of what it is at the moment, which they probably never thought they'd have to fucking do, because they thought they were probably just we're going to make so much money out of this joint when the prices were high. Things like, are they going to hone in on, because it's underground, so much more flexibility to go down here instead of going over there if that's high grade. Like they've got a lot more flexibility, so that's the advantage of the underground. Whereas a pit, it's all in a sequence effectively. So are they going to hone in on high grade areas and high grade it to reduce the all-in sustaining costs effectively? Are they going to, other one is around the con, because if they produce a lower grade con, so low fives, or could even go lower if they want, you can throw more tons through and get a better recovery for a lower grade con at the expense of the concentrate sale price. But Tonio did mention on the call that it's whatever method yields the highest amount of lithium units. He said if it doesn't produce more lithium units, it doesn't make sense. So you could produce a lower grade con and smash the tons through as quick as you can and create more lithium at a lower sale price per con ton. So it'd be interesting to see where they strike that balance of what that product's going to be. But yeah, $2 billion company at these prices. Still, I just, and we've mentioned it before, I just don't think the market would sneeze if they raise $300 plus right now to de-stress the balance sheet, because having $662 million in debt for a single asset producer in a depressed pricing environment that in a way is living on a bit of hope at the moment that prices are going to turn around sooner rather than later, it just doesn't sound right.
It's not sustainable.
Those numbers.
It's not sustainable. Yeah.
What sort of discount do you reckon they'd have to do? I mean, it's a bit of a sign that, you know, you're not quite getting there, and to incentivize the investors to come on board, you're obviously going to have to do, I think it'd be a healthy discount. What do you reckon?
Don't know, 20%, 15, or maybe 15, 20?
Nah, that's your stock standard. I reckon it'd be,
You think so?
I reckon it'd be heavier.
But it's it's trading at the price at the moment.
It's
based on what they're doing. Like that's the market's valuing it at 80 cents right now.
I hear you. Yeah. I mean, it kind of puzzles me that it still trades where it kind of does, but I think there's a bit of a, you know, unquantifiable backer. You know, you got Gina there and other sort of forces, and just a sort of belief that it kind of gets through.
Yeah, and like, because as we said, like the Platts and fast market spot prices haven't moved, still at $750 to $750 a ton. So maybe on the back of Pilbara taking out effectively 150,000 tonne out of the market with the P850 to P1000, maybe another operation going on care and maintenance could be a catalyst for a bit of a spot price lift, but at the moment it's all just a bit of a waiting game and a gamble. For things to turn around.
The Zimbabwean asset came offline as well.
Yeah. I don't think they're limited to doing a cap raise to relieve kind of, you know, pressure. They can sell Baldania. They can also sell call it a 30% interest in Kathleen Valley if they wanted to, and end up with the JV, and both would bring in some you know, short dated cash that might be handy for a period of time. But your broader point is like, you know,
it wouldn't be perceived that bad.
The status quo is not sustainable. Yeah, it's like you kind of you're playing the waiting game is it's a tough strategy when there's a bunch of other, you know, things in the market that point to depressed prices for longer, like what bloody Pilbara just did as well themselves. So yeah.
Do you think we're talking different commodities here, but we're seeing sort of the equity interest in gold at the moment. There's a lot of raises going on. Do you think that is commodity agnostic?
No, I don't think so.
Do you think it's a broader market thing that it might be a good time that equity will you'll be able to fill books pretty easily
think
across the market.
I think Pilbara could. I think Liontown could fill their book. I mean, their short interest is like sort of just sub 10%. I think. I mean,
it's a bit over.
A bit over. So I mean, like
10.8 or something.
Like you're gonna fill a book just with a good chunk of the shorts closing out, in a placement. So no stress.
Just on the discount.
On Baldania, you mentioned there, Trav. Do you think they'd get more than a few bucks for that? What's it? 15 million tons at 1%?
But no idea. To be honest,
surely there's some frigging gold rights down there, or something, or maybe something next to the tenement that's got gold potential. They could get some cash out of. Ask Shannon McMahon, I reckon, or Shannon McMahon's kids. They know shit about tenements. Anything the word with McMahon in it means historical tenement expertise. So hence the name McMahon Mining Title Services. So, mate, bloody...
Not just Shannon, mate. Doesn't stop there.
Look, Eva, Helen, Shannon, if you're bloody listening, fire up that friggin' Generation 7 AI-driven quantum computer and go just check Baldania, check around Baldania, give Liontown a call, just see if there's any ways they can get a bit of cash in the door. Liontown, get your hand on that landline right now, because MMTS are probably going to give you a buzz very shortly with something that'll blow your mind. Even gold rights near Kathleen Valley.
Yeah.
There'd be something there. There's something somewhere.
Probably.
Actually,
there would be.
Eva, call me first. I'll spin it out. Oh, right. Pilbara, JD, PLF.
Yeah, the lithium trend continues, but a slightly different sort of tone here. So they came out with a quarterly and a quick update on the midstream venture that they'd signed a year and a bit ago now. So quite a bit going on, but in short, operations were pretty solid, but there were some big sort of calls that they made that outweighed the operational performance that they had this quarter. So starting on operations, and then I'll go through some of the bigger talking points. Volumes were kind of down just a little bit. Mining rates are ahead of their internal plan, so looking good on that front. Significantly more waste has moved this quarter, and that'll sort of help them unlock new ore bodies, all kind of as planned. Recovery's ticked up a bit, so 75%, up 3%, pretty decent, and partially that's thanks to ore sorting. So the P680 commissioning is all done. They're now ramping that up. And P1000 is 80% complete. And the messaging here is that they're in way too deep. There's no turning back. They've got to spend the rest of the CapEx, get that finished and sort of get it online. There was another line that sort of stood out to me. Matty, you'll love this one. Water exploration and production bore drilling needs to be done to meet future expansion. Water requirements will continue.
Oh, hi, is that Greenland's on the phone? Bloody, that's how that conversation went, JD.
No doubt about it. We know there are good operators up in that area, and it's sort of no hiding the fact that you need water to run these mines, don't you, Matty?
Mate, you need water to run mines. Sometimes you need to get rid of water to run mines.
That is also something that Greenlands do.
If the word water is in your problem, Greenlands are the solution.
Turnkey solution, Matty.
Caleb
Turnkey.
Martin, the bloody, what a service to the industry. Thank you, Caleb. Get up to bloody, he loves the Pilbara. Loves flies, loves heat, loves cyclones, loves dust. He is your man. Greenlands are the men and women.
They sort it all, the works.
Oh, beautiful. Yeah, anyway, we digress.
So getting into the cash and kind of, I think it's interesting to bear in mind the other operations we're kind of talking about, even though they're a bit short on details, but the unit operating costs for Pilbara were US $480 a tonne. That's your price including the CIF I'm quoting there, so including your freight and your royalties. That's relatively steady quarter on quarter, so pretty solid. It's even less than the revised guidance that they've given, which I'll get into. So, I mean, they did sort of preface that with these aren't indicative of what the rest of FY25 costs will be like. Unfortunately, on your sales side, revenue was down over 30%. So The sales volume were down marginally, and your price was US $682 for their 5.3% product. So all up, that leaves you a margin of about $50 million. But if you're talking about your cash margin minus your capitalized development costs and your sustaining CapEx, which kind of has to be done, you're losing money, or you're sort of marginally break even. So that is the problem that they had to address, essentially, and that's why they've made the decisions that they've made. That culminates in the first of sort of three big talking points I've got. We're putting the smaller plant they've got on care and maintenance. So the Pilbara plant is going to be prioritised. That's the lower cost, better plant that they've got. Unfortunately, this means 50 jobs will go. It also means 100,000 less tonnes of spod will go out versus their previous FY25 guidance. And if you're looking at over a full financial year, say FY26, it becomes P850 as opposed to P1000. Yeah. But you've got your cash flow benefits. So the company's talking about $200 million in cash flow improvements if you're taking into account a US $700 spod price. And this is a factor of the mining fleet going from 7 fleets down to 4. That'll save you $45 a tonne. And reduce CapEx, another $63 million saved there, and then a couple, bucks saved in reduced corporate costs as well. Interesting, they said it'd take 4 months if they want to reverse that decision. But ultimately, like you were saying with Liontown, Maddie, this is tons coming out of the market, and it's something some of the other operators out there are going to be pretty happy about, I reckon.
Good to say, even with $1.4 billion in the bank, they're being prudent on the millions.
Well, yeah, absolutely. I want to talk about that more in a moment. So the other big talking point is price realizations, and I've got a neat chart here that Citi put out. It's no sort of secret, but Pilbara get relatively bad price realizations. You can see they're sort of bottom of the pack there. So US $682. That you compare that with what IGO put out, US $872. That's on an FOB basis. It's not sort of perfectly comparable, but it's a pretty big difference. That's partially a factor of them having their shipments weighted to the September month, so the last of the 3 in a sort of downward trending market that doesn't do them any kind of favours. And then on the balance sheet, like you said, Maddie, so about 1.35 billion Aussie in cash, 370 million is what they last reported in debt, so that leaves you net cash of 1 billion. This came off $270 odd million over the quarter, mainly due to CapEx. So that again just tells you that they're about kind of break even at these prices roughly. And of course they did sort of sign up the $1 billion in debt, but it sort of leads into the decision making which the company's kind of gone through, and the decision to shut down the plant.
Yeah, and what about the downstream? How good's downstream?
It's not as flash, although it could be worse. So, of course, they've got the POSCO downstream. Train 1 coming online, did 50% of nameplate in August. Train 2 is completed. That's in commissioning. They've got a bit of debt. Remember, they sort of own 18% of that JV with the option to go a bit higher. And then on the midstream with Calix, that's essentially just been paused. So they're in a very conservative kind of mode now.
There we go.
It's super interesting though, right? Like the rhetoric up until I felt like this quarterly was from Pilbara was continue the kind of capex, lower unit costs, and survive the cycle that way. And now you're seeing like rationalisation on quantity, which is a bit of a detour from prior. But if you just look at all of the producer peers, they're still the kind of maybe best equipped from a balance sheet perspective to ride out the storm.
I think start of next year is going to be D-Day for lithium. It's going to be action-packed, I reckon, because all these other producers can't survive like this. They won't be able to do this forever at these prices, which will either mean or the lithium global bloody demand increases. Something's going to happen, which will be a catalyst for something, because if they can't survive, tons are going to come out of the market, which will be that's what's going to bring in the prices, or
exactly
as you said,
it's the distressed care and maintenances that are kind of required to sort of, take enough tons out of the market to, lower prices, the cure for low prices, because it can curtail supply. You need more of that supply curtailment, absent demand just, going bonkers again. But
it's like, who's going to blink first?
Yeah.
I think I agree with what you guys are saying. I had to kind of go back to basics in thinking about what all this kind of means, and is it good, is it bad, and just going back to the cost curve again. That's what really matters, and that's sort of implicitly what you guys are talking about. Like you say, Matty, Pilbara have a strong balance sheet relative to all the other players in the market, and they've got decent enough assets. If you sort of think about Pilgan and the smaller plant for a moment separately, because it's kind of how Pilbara have thought about it here, it is kind of puzzling, or maybe conservative is just the right word, or maybe discipline's the right word, that these are the guys that are curtailing production. I had sort of similar thoughts when it happened with Greenbushes half a year or so ago. I find it super interesting that these are the players that are doing it before the higher cost peers. And essentially the decision they've made today is to save money in the short term and forego earnings in the long term. Pretty much every broker has come out and marked down the price target and the NAV for this company for the decision.
The share price rallied though.
But it did. And it sort of divided analysts out there, because a lot of them, to your point, Trav, we're happy to see that they're responsive to market conditions and pulling supply out and not just going for that volume decision, volume over cost. Whereas others, not too many, but there were a couple analysts sort of who were not quite as positive about this decision, because they think the company's just being overly conservative because they are the preeminent player in the market. So, I mean, maybe given everything Pilbara's been through, it's a pretty hard-won lesson to be conservative and see yourself through no matter what, even if that means you get a bit less of the cream at the other end. And, who could kind of blame them given how close things got a few years back for them making that decision?
But they could turn this back on pretty quickly, yeah?
4-ish months is the kind of guiding that they've given, but you'd only do that after an indicator that the market's improved, prices are picked up, so you're sort of implicitly they're missing out on some earnings.
Do you think taking 150,000 tonnes out yourself, they're thinking would they? I don't think so. We might get paid more for the other 850.
I don't think that it's a big enough impact. Back in the day, the smaller lithium market, I think what I've heard is that was the way Albemarle used to think about the market, was they could sort of their own curtailments here or there influence the market a hell of a lot, and they thought they could still do that. And that was the Greenbushes decision you saw earlier in the year, was sort of Albemarle's own thinking on a niche, chemicals business, but it's a much more fragmented kind of market these days, and I don't think you can move it too much with 150,000 tonnes. Yeah.
Mm. I think the last sort of thought that comes off the back of talking about Pilbara there is just relating it in the context of other commodities and other companies out there, and gold is the one that comes to mind. It just can't help but think now is the time to secure your balance sheet. You've seen some of the smarter companies out there, some of the better operators grab at the opportunity and just raise the capital while you can. It's not applicable to everyone, but it's something I'm sure all of the companies are seriously considering. You've got to kind of take the cash. All these lithium players wish they would have done more of it back in the day. And I think it's just a lesson as an investor as well to sort of carry in and think about how commodities sort of cycle.
Right. Good work, JD. Next up, Meeka, the bloody prospective gold developer. First thing I saw here, I'm like, fuck, they're raising money again. Mm-hmm. Because they just raised $35 at 5 cents on 3rd of September.
I remember.
Exactly my thoughts.
And they put the 26 mil gold loan and 12 mil gold stream in place. But as you can see on the Spark chart, since that raise, Meeka's been on a bit of a run along with the other gold. He's actually hit 9.2 cents after raising at 5. But today, they're raising $35 a minimum, $35
Yeah.
at 7 cents, and they'll accept overs and also possibly put in a share purchase plan. So might end up raising a bit more. 9.5% discount to the last close price.
Yeah.
Why, you're about to ask Travis Ricciardo?
I reckon I can guess.
I'll tell you. Well, in a move, positive move, similar to what we talked about with Black Cat on Tuesday, they're effectively removing the Oramet gold loan and gold stream, which they put in place early September to fund the Murchison Gold Project.
Yeah.
Now, why would they do that? What is it worth? Why don't we go for a trip back in time? Because if I talk about it, it doesn't do it justice. When we've got the Murchison Gold expert, Ali GC, in our building every day, why don't we listen to the wise words of her?
Essentially, regardless of the gold price, Oramet give Meeka $26 million to get $35 million roughly worth of gold over a 12-month period. So that's a 35% return in a year.
For Oramet.
For Oramet.
Yeah.
And that's not including they've sold them some gold call options as well. And they're also getting 25 million warrants from Meeka. So that would sort of juice up their return even more as well.
That's a good deal.
For Oramet, yes. So then moving on to the gold stream, which we sort of touched on before, Maddie's, Meeka get $12 million from Oramet. In exchange, they have to deliver 4.25% of the total gold that they produce to Oramet until 5,000 ounces in total is delivered to Oramet.
Yep.
And Oramet buy those ounces at 20% of whatever the prevailing spot price is at that point in time. Then they've actually got sort of an additional stream on top of that. Once the 5,000 ounces from the main gold stream is delivered, then there is what's called a tail stream. So 1.5% of gold produced for whatever the remaining life of mine production profile is, they can purchase at the same price, or 20% of the spot price. Meeka actually have the option to buy back 80% of the tail stream, so that 1.5% component I spoke about, for $5 million to reduce it to 0.3% of gold production rather than 1.5% as well. So if you assume the same forward gold price we spoke about before, just shy of 3,900 Aussie, Oramet basically giving Meeka $12 million to get back 15.5 million, sort of worth of gold. That's the first 5,000 ounces.
Yeah.
My very rough Excel calcs on the gold loan and the gold stream inclusive of the tail stream based on the DFS production profile and that gold forward price we discussed earlier, just shy of 3,900 an ounce, have Oramet generating at least a 30% IRR over the life of mine. And that does not include, the call option, and doesn't include the warrants because that was too hard for me to figure out.
So, good work, Ali GC. Plagiarism at its best, Matthew. So that's effectively, as we established, Oramet do these things, people like Oramet do these things because they make money out of it. So raising the dosh now has removed like all that extra margin they were going to have to pay Oramet for that funky debt, you'd say. Obviously don't have to issue the 25 million warrants now either. And Oramet also had first ranking security over the Meeka assets as part of that gold loan and gold stream. So no one has security over it now. So
yeah, I don't mind that, to be honest. We've seen so many times in WA gold history where there's just trouble negotiating with whoever's got the senior secured loan. It's just they've got all these covenants. I'm not saying this one had that, but it's just better and easier, and you have more flexibility to ride whatever comes at you without that in the cap structure.
Yeah. So pending they assume they're going to fill the book, and which you could bet me bottom dollar on that. They're obviously saving a good chunk of future cash that would have otherwise went to Oramet, removed any risk associated with delivering the gold, and security over the assets, fully equity funded, completely unhedged, and they've done this raise at a 40% higher price than the previous capital raise. So because they had $27.5 worth of cash, 29th October, add another minimum $35 to come in the door here. So 62.5 pro forma. So 22 mil of that is for working capital, buffer, contingency, other working cap and corporate costs. So there's big chunks still allocated for that. Said $5 million for an accelerated underground mining strategy. So it looks like they'll be re-establishing and rehabbing and getting back into Andy Well early next year. Mm-hmm. That's obviously where the your higher grade dirt is. So if they can raise even more than 35, they're going to be in a pretty bloody good spot. So first gold will be due start of bang on. They've scheduled FY26.
Yeah,
but you'd be anticipating they'd be pushing like motherfuckers to get pouring before then. So yeah, I think good equity support that we're seeing in the gold junior miners at the moment. Great for the industry in terms of, because the equity funding removes so much risk for the developers themselves, more chance for them succeeding, a lot less risk for the mining services companies that are supporting these developers and working for them. Because how many situations have you seen recently where a developer is debt funded, the lender calls on the debt, the mining services companies are at the bottom of the barrel trying to get paid. This is what we call a true win-win.
Yeah. And Calidus is like the distressed example that comes to mind, right? In that case, they put so much debt in there. I think it was maybe an intentional strategy, but they also like getting the equity was a hard yakka for them. It was like their market cap was so kind of de minimis relative to, it was always a bit undemanding that the way they could actually get that built was with a maximal debt funding kind of structure. So I don't like, things are different now because gold price is humming to the extent where you can just fully equity fund the restart and development here, which is, I just don't, you're not going to get situations like Calidus, right? Because it's equity. Just worst case scenario, you raise more money.
Good on them. Good work. More go fucking underground. Love it. Love it. Love mineral mining services. Buddy, tell you what, Meeka, you want another mention? Highly recommend giving MMS the contract. Means a screenshot. Fucking can't make it any simpler for you.
Who else should they get on board, mate? Tell me.
Well, they should grounded for a bit of a refurb of the camp or an expansion if they find more gold. CrossBoundary Energy for the hybrid power station up there. That'd be a wise move. Obviously, Sandvik Ground Support's what's going to be going into Andy Well. Mate, Steve Tarr will broker probably the best insurance policy with absolutely no holes in it for the Murchison Gold project. Greenlands, I have a feeling they've been used already up at Meeka, so well done, Meeka. K-Drill, hey, you can't find too much gold, can you? Go find a bit more. Bloody MMTS, they probably got the tenements for him when they chucked it in the backdoored it into the shell anyway. That's a given. Bloody Reese will get up there. He'll start clearing for whatever they need just to get this humming. So first gold before FY26 easily if Australian Earthworks and Haulage are helping you. And as we said, we've just watched the Meeka share price go up on a spark chart. Hooroo, money miners.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.